You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment expert, Danny Newberry. Now, whether you know it or not, Danny is a repeat offender here in our show, but it's been many, many years since we last had Danny on, and so I thought it'd be great to bring him back and get an update on his business and what's new in the life of Danny and investing in real estate. So, in fact, if you haven't already listened to it, I'm going to mention this. If you haven't already listened to it, be sure to go back to episode number 30, which was a long, long time ago. That was a different time back then. Episode number 30. Listen to that first show that we did together. You'll learn a lot about Danny's background. We're going to do a quick overview of it today, but you can learn a little bit more about him and how he got into real estate by listening to episode number 30. And just one other point I want to make. Actually, I follow Danny on LinkedIn, and so I see his updates on a regular basis, and I can tell you that this guy's absolutely been going gangbusters and kicking butt with acquisitions over the last few years. More interestingly than anything to me, as I follow these updates, is it seems as though he's changed or somewhat changed his focus from multifamily, which is what his core focus was a few years back, and switched over to more commercial real estate, retail, office space, industrial. And so I'm very interested to find out what's going on in his business and what really prompted this change of focus. But before we jump on to the interview with Danny, I want to run through a few quick items with you guys. First off, we are in acquisition mode here at Sunrise Capital Investors, and we are actively seeking mobile home communities to purchase. Just so you know, we're open to joint venture arrangements or even paying out big finder's fees for the right deal. So if you run across a mobile home park opportunity that is a minimum of 60 spaces in size and are looking for either a team to help you take it down or maybe someone to flip it to for a profit, so you can walk away with a big fat finder's fee, please think of me and my team. You can actually email me directly, kevin@kevinbupp.com, and give me any info that you might have on an opportunity. We can handle deals as high as $25 million. So we're well-funded, well-capitalized, and have money that we need to spend today. So if you come across an opportunity, you'd like to chat about it, again, shoot me an email, kevin@kevinbupp.com. We're always looking for individuals, accredited investors that have an interest in teaming up with us on future opportunities, okay? So we always have a pipeline working, always looking for active investors to participate with us on our deals. So again, if you're an accredited investor and you have an interest in putting your hard-earned money to work, and what I feel is one of the most proven asset classes known to man, mobile home parks, you can go to our website and learn more about the opportunity. You can even download our private placement memorandum and read more about our company. The website is sunrisecapitalinvestors.com. Lastly, guys, if you happen to be in the Tampa Bay area, I'd love to meet up with you if you have time. During your visit, you can email me directly, kevin@kevinbupp.com. Let me know when you're coming, and we'll try to coordinate a time to get together and grab a coffee, a bite to eat, or something similar, okay? So, guys, without further ado, I'd like to welcome back Danny Newberry to the show. Danny, how you doing, bud?
Hey, Kevin, how you doing? I appreciate you having me on the show. Looking forward to being back.
I'm looking forward to catching up with you, man. You've been going gangbusters. You've been setting the world on fire, investing in real estate. And I know last time that we spoke, Danny, which was a long time ago, episode number 30, it was like 2.5, 3 years ago. So quite some time. Back then, you were going gangbusters as well, but it seemed like your main focus was multifamily more so than anything. I know you had some single family properties kind of transitioned into multifamily, and you guys were buying lots of multifamily properties. And I've been following your LinkedIn updates. Again, every time you guys buy something, you post it on LinkedIn, I see it, and I'm like, man, what's happening here? I think Danny's making a little bit of a shift. I see, commercial properties. There's some retail there. There's some office space, medical office. I think there might have been even a few industrial properties speckled in there. So I'm really interested to learn what's really happened over the last couple of years since we last spoke. Get an update on your business. But before we go there, because I'm real excited to go there with you, but before we do, just for those who haven't had the opportunity to listen to you maybe on my show or one of the other podcasts you've been appeared as a guest on, just take a few minutes, tell us a little bit more about your background, Danny, and then we'll dive into all the meat and potatoes and learn what's going on with your business today, okay?
Excellent. That sounds good, Kevin. So just a little bit of background then. I'm 29. I live here in the beautiful state of Colorado. And I originally was born in Mexico. My mom's Colombian, my dad's American, so don't ask me how that happened. We moved to Southern California, was there till, I want to say 10 or 11, and then moved to Utah. Was out there for, I want to say a good 15 years. And then me and my wife, we moved around. Really, we were chasing multifamily deals. And so wherever we bought a new deal, we would literally pack our stuff and move on site most of the time. So we moved to Vegas, we moved to Oklahoma, we moved to Colorado, and then ultimately when we were back in Utah, we decided, hey, we want to put some roots down, and we really like the Rockies. So we ended up out here. But during that time, when we first got started, just like everybody else, we started off in single family, small apartment buildings, so duplexes, fourplexes, sixplexes, et cetera. And then we slowly built that up to about 250 rental units, getting up into some of the larger apartment buildings, 100 plus units. And then after that, we started to dabble in commercial property. So I think the first building we bought was a medical building. And then from there, it just started to morph. We bought a couple small shopping centers and then some office buildings. And really what we were trying to accomplish was learning all aspects of commercial real estate and really trying to figure out where it is our strengths and what we like the best as far as, our assets and what we're holding and where we see good value. And so, originally when I started, I thought, I was going to build the portfolio and the multifamily to a couple thousand units, and quickly realized that the tedious day-to-day work with tenants and dealing with, constantly having to turn units and, fix these things back up. I mean, the tenant never walks in and hands it back to you better condition than what you gave it to them in. So we just got really tired of that. And we soon realized that triple net leases were a beautiful thing. And basically what that means is that the tenants in commercial real estate will pay for the taxes, they pay for the insurance, and they pay for the CAMs, which is the common area maintenance, and everything inside their suite as well. Really, the only landlord responsibility is structural and roof and sometimes HVAC. But for the most part, your tenants don't call you very often. I mean, they do, but it's a lot different scenario dealing with a professional tenant versus a renter tenant. And so, we started buying all these kind of properties in, I want to say about 8 states. Right now, I think we own in about half a dozen states. And I got to tell you, we absolutely love commercial real estate. I mean, there's nothing better than, these triple net leases with the shopping centers that we own and the industrial complexes that we own. So, our goal is to continue to grow the asset base in the Southwest, Northwest, and Rocky Mountain region, but really focusing on shopping centers, industrial complexes, and medical/office buildings.
Very interesting. I have so many questions, Danny. So many questions. I guess first off, I want to back up a little bit. You mentioned that one of the things that you were somewhat getting tired of or sick of in the residential space, in the multifamily space, was dealing with the tenants and the turnover and always having make-readies in units that became vacant, right? And just in the turnover is on a regular basis. I mean, if you get a tenant that actually stays more than a year, then you're doing great. So I'm assuming that you guys were self-managing, or did you have your own internal property management company that managed these properties, or were you outsourcing it?
We did both. So, and the biggest thing is I love multifamily still. I still plan on investing in it. I still plan on having it in the portfolio. But, ultimately, yes, I would from now on always hand it over to a third-party manager. The problem that what we saw in our own business is most of the multifamily that we bought we were buying at the very bottom. And when I first got started in my early 20s, I felt like, hey, I can't afford the nice Class B asset that's, 40, 50,000 a door. I was literally buying the stuff that was in, the roughest areas of Vegas and Oklahoma. And really it was just trying to manage that, even with a third-party manager, was a full-time job. So, we went through so many management companies, constantly firing and hiring, taking it on ourselves. I mean, it was just, really we were buying Class C properties that probably should have been Class D. So they were pretty rough properties. And if I had to do it all over again and tell my younger self, what I do differently, I would definitely stay away from anything, even Class C at this point, unless it's in a true Class B plus area. I really wouldn't touch it. I know a lot of people do great in that area, but they also, that comes with the headaches and the day-to-day struggle of trying to keep those things, occupied and cash flowing.
Got it. So talk to me about, I want to talk about the transition that you took into the commercial space. And you made some mention to a few of the reasons that you started looking elsewhere outside of multifamily. But I want to learn more about, the different asset types that you've gone after. You said medical office, retail, industrial. Give me some of the trends or some of the reasons for attraction to those three specific asset types, if you would.
Yeah, absolutely. So, really, there's a lot of reasons why I like this space, but some of I think I already kind of mentioned it, but some of the reasons I truly like commercial real estate is you can really track your cash flow very, very easily. In the multifamily space, I had a lot of ups and downs, where, 1 month, we had a great cash flow month. And then the next month, you lost more tenants than you thought you would, and you had to put more money back into the property. With the commercial properties, you're usually signing 5, 7, 10-year leases with your tenants. So you lock it in, and it's a base rent with a CAM, a triple net fee on top of that, where they're paying your taxes, your insurance, your common area maintenance. So they even pay you to manage them. So part of your common area maintenance is going to be, your management, your maintenance, your landscaping, your this, your that. I mean, it's really all included, and your tenant pays for that. So I like the fact of my cash flow being something that I can project out for many, many years. I can say, okay, look, based on the leases that I have, based on what my income is, my expenses are paid by the tenants. I can project, a 15% ROI in year one and a 20% in year two. So you just have a lot more stability in the cash flow, very consistent. What I do with my properties, my investors love this. I literally just go on auto pay every single month, cash flow checks that go out, and they're consistent every month. And every 6 months we go in, we'll look at it and say, hey, did we cash flow more or maybe a little less? And then we'll change it, but we don't need to go and change it every month, right? We might only do it once or twice a year at the max. And it makes it very, very, it's just a lot easier. It's very easy to scale. It's lucrative. It's very easy to, really build the portfolio because you're not having to micromanage all these assets. And that's what I really like about it. Okay. I have a partner of mine that always says, it's the evolution of a real estate investor, because I think we all start out in the same place. And look, you can do really, really well in single family, and if that's what you love and that's what where you're on fire and you're killing it and crushing it, well, stick with that. But at the same time, I got a little burnt out with the single family and multifamily, and it was just the evolution to go here. And I think with the commercial side, the true commercial side, is that it's a lot less management and a lot more brain damage, because really what you're trying to create at these properties is, really strong leases. You're trying to create great tenant mix. You're trying to get good synergy. You're really I've had a lease where it's taken me 8 months from start to finish, going back and forth, just to get one lease in place for my property. I mean, that you'd be, if you're more than an hour into it with a potential multifamily renter, that's a lot of time, right?
Sure.
So, I mean, there's definitely a lot more brain damage and a lot more pieces of the puzzle putting together, and I personally enjoy that more.
Okay, fantastic. Well, I want to talk to you a little bit about the value add component, because I know that some of the recent acquisitions that you've had, I've read your blurbs on LinkedIn, and on a few of them, I can recall that there was some vacancy at the time of acquisition, or I guess during your contract period prior to closing, there was some vacancy, whatever it might have been. And on a few instances, you actually had a committed tenant ready to sign a lease, or that had already signed a lease prior to you actually closing on the property. Talk to me a little bit about that value add component and how you've been able to determine in situations like that one, how you've been able to determine that there is a demand and you know how to do a better job than basically the person you're buying it from in filling that space up.
Oh, absolutely. And that's another reason when it comes to commercial, again, it is brain damage, and I think it goes beyond, a lot of people's ideas of how it should work. Like, hey, here's the space, take it, rent it, pay me money, like a multifamily or single family residence. With commercial, there's a lot more to it on the leasing, on, getting people in there, on, coming to an agreement on an LOI of what the deal is going to look like, how much tenant improvement dollars is the landlord going to provide, how much is the tenant going to do themselves on their own build out, how long is the lease? I mean, so many things. Is it going to be recourse, non-recourse? Is it going to be, there's just so many dynamics to a commercial lease that a lot of the properties that we're finding are people that, either one, they don't understand it fully. They're not willing to give tenant improvement dollars, which attracts good tenants. And so, you're going to get people that are just literally coming in and setting up shop like a thrift store that doesn't, isn't really trying to, increase the look and the feel of the center, versus, someone who is coming in and really adding value to your center. And so, the thing about these value add deals is that when we go into a property, we're always looking to add value. And so when I look at any property, I'm saying to myself, how am I going to add value, not just for myself, but for the tenants, for the neighborhood, for my investors, for the whole picture. How is this going to be a better deal than what it is now for everybody who's involved? And that's the way that we look at it. So we go in and we say, look, these tenants, I just bought a building, and I want to say it was $30-something bucks a square foot, about 65% occupied. And the roof was leaking. The parking lot had holes, bigger than a foot wide, and so it's just it looked terrible. The facade was terrible, and no lighting at night, and it was just okay. There was the writing on the wall for us. So we went and talked to all the tenants. They all said, "Look, I'm about to leave because it's just I've been going on too long. It's a detriment to my business. I have a professional company, blah blah." And so we went in and said, "Okay, how we can create a lot of value here." We went in and we put in brand new roof, brand new parking lot, brand new facade, brand new lighting, brand new landscaping, and the tenants were extremely happy about that. So what did that do? That created a good atmosphere, and then we were able to fill that vacancy. The last 35%, within 3 months, we were full to 100%. And, I was able to increase the rents of everybody because I also went in and I said, look, your space looks tired. Why don't we go in and really upgrade it? You've been here long enough. People know you're here, but let's really give it an overhaul, get more people in here. Well, that's what we're creating here. And so we were able to get everybody to renew their leases for long-term. Most of them were month to month. I got 5 to 7 to 10-year leases on all my tenants in there. I'm 100% occupied in less than 6 months. We're looking at an NOI when I bought it of 70,000 to 230,000.
Wow.
So it was a huge, huge in the numbers, but it really, all it took was saying, how can I better the property, the tenants, the neighborhood, and it was actually pretty easy.
Okay. I want to talk about that example you just gave a little bit more. So 70,000 of NOI when you purchased that property. Give us an idea. Can you tell me what you paid for that property?
I paid $700,000 for it.
Okay, and what that was? How many square feet was that particular structure?
That property was a little over 20,000 square feet, and so I put about $400,000 into it.
Got it.
So after the roof, the parking lot, the facade, the tenant improvements, leasing commissions, all that. I'm into it for about $1.1 million, and I'm getting a valuation now. I bought this in April, and my valuation on it, based on an 8 cap, is about $2.8 million.
Yeah, that's fantastic. Good job, man. That's a good success story. Talk to me about the. Go ahead. Didn't mean to interrupt you.
Oh, I was just going to say really quickly, but on valuation, that this is another reason I really love commercial. And it comes back to the pennies in commercial. If you watch your pennies, you can make millions in this business. So we had tenants that were paying $6 a square foot. Well, the market rate rent was more like $1 a foot a year, so $12 a square foot. Mm-hmm. And if I'm able to double their rents and they're not complaining about it because of all the things that we were able to do, and also giving them money to fix up their space, their flooring looks tired, their walls look dirty, their lighting is outdated, or whatever the case it may be, new signage, channel letter signage, all these different things that we went in and did. By doing these things, you can make small moves and create such huge gains in commercial real estate. That's what I love. I mean, literally one lease could be worth $500,000 in added value to a commercial property. And that's really what we like to find. We like to find something where, hey, I just bought this industrial deal, 66% occupied, and I was able to get the tenant to renew for an additional 5 years. Anything under 3 years, a bank is going to look at and say they're going to discount the value of that lease because it's not as secure as like a 5 or 7 or a 10-year lease. And so we were able to get the valuation to go from like with a 1.7 purchase price that we bought this property for. And then by filling 2 vacancies at market rate rents and renewing that tenant, we're looking at a valuation of about $3 million now. And these were small moves. It wasn't like, I went in there and did a whole lot of things. I was just able to renegotiate a long-term lease. I was able to backfill some vacancies that the previous owner wasn't able to do, and put in a good marketing plan and bring on the right leasing agent. And it's not as crazy as most people think to be able to create $1 million in equity in a property very, very, very quickly.
So let's talk about that industrial deal then. What I want to know from you is that, so when you looked at it, it was 66% occupied, and you said you had 2 vacancies that you had filled. What was the process for you to feel comfortable? Obviously, you probably wouldn't have purchased that property if you didn't feel confident that you were going to be able to fill those other 2 vacancies, right? Can we agree on that statement?
Correct.
So how? The question is, how did you gain confidence prior to purchasing that? Was it just a matter of calling up, a few of the top industrial leasing agents in that market and getting their gut check as to, do they have any interested parties or potential prospects in mind that could be a good fit for that space? Should the terms be right? I mean, is it as simple as making a phone call?
So yes, I mean, not as simple as making a phone call, but yes, you go out there, you call the right people. So what we do is we look at an area and we say, okay, first of all, what's going on in the area? Who are the employers? What's the vacancy and the absorption look like? Is there a lot of competition? Is there a lot available? On this particular asset that we bought, I think we bought it in August. It was 30,000 square feet, and we had CDS Global in there, which is part of the Hearst Corporation. And they only had, I believe, 18 months left on their lease. So, and then there was 10,000 square feet of vacancy. I'm like thinking to myself, this is a risky deal, because what happens if I buy this and then my tenant leaves in 18 months and I'm dealing with the 30,000 square foot big box vacancy, right? I'm losing here big time. So what I did in the contract is I structured a 90-day due diligence period where I could renew, lease up I could renew current tenants and lease up vacancy during my due diligence period. So 90 days give me a lot of time to go into the market, figure out, okay, hey, there's hardly anything available, first of all, in this size range for industrial property. Everything else is full. Well, that's a good sign, number one. Number two is I went to CDS Global and I said, look, I'm going to buy this property, but it's way too much of a risk for me if you don't renew before I close. And I don't know what the seller is going to do, if they're going to up your lease rate when you come due or what the case. But if you're willing to renew and do a brand new 5-year lease, I will keep your rate the same. and we're all happy. We all move forward. And so they came back and said, okay, we'll do that. So I renewed them, put a brand new lease in place, and they also had a clause. And this is the thing about commercial real estate. You really have to read all the leases because they all have different things. Every one of them says something different. They had a clause in their lease that said if they wanted to vacate the state of Arizona, that they could give a 30-day notice to the landlord and vacate with no
Oh, wow.
no personal recourse, right? So that we couldn't go after them for the rest of the lease term. And I said, I absolutely need that out of the lease. I can't do the deal unless you take that out. They were willing to take it out, so I secured my tenant for that. And then during that time, I had leasing agents that focus on industrial in that area, and they were able to land us 2 national tenants for the other vacancy. I still have 1 vacancy in that building, but out of the 3 vacancies, I filled 2 of them, and one of them was signed before we closed, and the other one was signed right after. And so, it's one of those things where you can do that on buildings. People think, well, there's a lot of risk in this deal, so I'm not going to look at it. Well, wait, hold on a sec. What if you can structure it where you get enough time to go in there and minimize your downside risk, create value, and at the end of the due diligence, if it didn't work out, if the pieces of the puzzle didn't work out, you can still walk away and you're okay.
No, that's fantastic.
Exactly. So, yeah,
I was going to ask you, is that a pretty common structure as far as like an LOI is concerned? Actually asking for that time frame and asking for the permission to do some marketing and potential lease ups during your due diligence?
So I don't think it's very common, but I have it in every single one of my LOIs.
Okay. Do you get a lot of pushback from commercial brokers as far as like, those representing the sellers? You get a lot of pushback from the larger commercial brokers when they see that in there, or is it readily accepted by most?
To be honest with you, I don't get a ton of pushback. Sometimes I do, but very often I don't. And the thing is, with commercial real estate, nothing's very standard. I mean, I got to tell you, we do things so out of the box, so creatively, that I don't think I could pull this stuff off on 99% of like residential or multifamily deals, just because in the commercial world, it is totally a different animal. You can structure things any way you want, and for instance, I get owner financing on probably more than half my deals. And, I either do that, or I get a seller second, or a personal loan, or, keep the seller in if I need, if my bank won't allow a second, you can keep the seller in as a partner in the deal, with a preferred return payout. There's just so many creative things you can do to make these deals come together. And, real estate's a slow moving business, as you know. And, on some of these deals, a lot of the deals that we're looking at least, they're a lot of them are value add and have a value add component. And so the current owners don't want to deal with that. They don't want to put in the time and the effort, or don't have the know-how to create something, or get creative to really turn the building around.
Yeah, that's very exciting. So I want to talk to you a little bit about the financing side of things. You just mentioned that a lot of your deals you get owner financing. Lots of times you get owners to stay in the deals or carry back seconds, or just lots of different creative structures. Talk to me about the conventional financing side of things as far as bank financing is concerned. Maybe give me the last couple of deals you've done as far as getting bank financing. What kind of terms is pretty common, or is there not common terms in the commercial space when you're talking about industrial versus medical office versus retail? Can you maybe speak to that a little bit and what one might expect going into one of these value add type plays that you so commonly do?
Yeah, absolutely. So we just got done doing a CMBS loan, and we did it on 2 centers where we cross-collateralized, because they were both in the same location. One was a Walmart shadow anchored strip center, and then the other one was right across the street from that. And so what we did, we bought it from two separate owners, and we quickly created value on both those deals, where we filled some vacancy and we stabilized the rent roll. So I went in this is another thing that I like to do is, as I already kind of explained, but like if you've got tenants less than 3 years left on their lease, during due diligence, go in there and talk to them and say, what are your plans? I mean, are you willing to renew early? And if they're not really willing to renew early, you really want to dig in and figure out why. Are they doing that? Are they not planning on sticking around? Or, what's the plan? And then that gives you ammunition if you find out a tenant's leaving, to go back to the seller and retrade for, a discount based on that. But we were able to renegotiate several leases at these properties. We filled a vacancy, and then we went back. I think we were all into both those deals for about 4.9 million, and it appraised for $6.25 million. This was all done in a year, and we did a CMBS. They gave us a 75% loan to value. We ended up pulling a little over $4 million out of the deal, so we got part of our cash out of the deal, which was awesome, and we got a long-term 10-year fixed note, non-recourse, which this is really important, guys. I mean, I can't tell you, based on where we're at in the market cycles, you really just want to make sure you protect your downside risk. And I always say, either buy the deal cheap enough and very low debt that it can support itself through a downturn and lose, having vacancies or reduction in rents or whatever the case may be. So that's number one. Or number two, get long-term fixed debt, non-recourse. And so that's what we did on these deals, is we got 10-year fixed money, non-recourse. And I think we're about 5%, 30-year AM. We didn't get any interest only on that deal, but that was a deal that we just actually finalized this year.
Okay, fantastic. No, you bring up a good point about protecting your downside risk, especially at the where we're at in the current real estate cycle, and that means so many different things depending on what area you're in and what type of asset you're investing in. But the non-recourse debt side of things, how does one, getting into the space, I'm talking about just commercial in general, especially when you start talking about value add commercial, whether it be retail, medical office, industrial. How do you suggest one protects their downside? I mean, you mentioned buying it right. That's obviously one way to protect your downside. Are there any other ways? I mean, if non-recourse is not an option, if you got to do a full recourse loan and it's on a value add type play, do you have any suggestions, any words of wisdom, any silver bullets of advice to anyone listening that might be looking to dive into any one of these spaces that you're currently in, and how to protect themselves if a non-recourse isn't an option right out of the gate?
Well, I always say, if you can get owner financing, hallelujah, do it. Because, sellers are all, even if they won't give you non-recourse, which most of the time they will, because they're putting their collateral is an asset they've already owned for, a long time and feel comfortable getting back. So, but if they come back and say, look, I'm willing to owner finance, but I want recourse on the deal, first of all, push for limited recourse. You can also do this with a bank. They all say, you call up a bank today, they all say recourse, right? Yeah. Unless it's like a 50% loan to value, then they say, yeah, we might consider non-recourse. But, if you're trying to, get 70 or 75% LTV, they're going to want recourse. Well, one thing is always ask for limited recourse if they can, and a lot of times they actually come back and say, yeah, we can do some limited recourse. So, or a burn off rate. So okay, after 2 years of you paying your mortgage payment on time, it burns off and then it goes to non-recourse. Or, we're going to give you limited recourse if you have $1 million loan. We're only going to give you, 500,000 recourse. So anything above the, 500,000, then we'll come after you for up to that amount, but not the whole million. So you can do that. But, at the end of the day, banks are really hard to work with when you're in a position where you can't pay the note and, they're going to foreclose on the property. And so, but a seller is, they're going to be a lot more in tune to, or inclined to work with you. I mean, you get on a phone call like me and you are having and say, look, I'm having these issues. Why don't we get creative here? I can't make the debt payments for the next 6 months because this happened, or I lost that tenant and I need to backfill it and I need to put money back into the property. Why don't I put those payments on the end of the note and I'll give you, a two points at the end of the loan, or whatever the case. I mean, you could structure it a million different ways, whatever works best for you. But, you have from a bank's perspective, they're not just going to get real creative with you. They're just going to say, look, you either pay up or we're foreclosed.
You're right.
Most of the time. So I think that's one way to structure that if you're going to go down that route.
Okay, got it. Talk to me about the management of these assets. And again, we're focusing on your commercial portfolio, not the multifamily side. Do you typically engage a third-party management company to oversee the limited management that these assets require, or do you guys just keep it in-house?
We manage about 90% of our portfolio in-house.
What does that look like? What does your management arm look like as far as staff?
I mean, seriously, it's two people. I mean, it is. I tell you, this business is very, very scalable because there's just it's once you get it set up. So what we use a Appfolio management, which is a CRM program that's all your management. A lot of people have it for multifamily. I used to for my multifamily. Well, they just came out with their commercial side. And so we have all of our tenants set up with their own portals. Everything runs through that, all the accounting, all the CAMs, all the maintenance requests, I mean, everything. So it's all in there, very easy to work with and manage. And it doesn't require a whole lot of time. I mean, I have some properties that maybe an hour a month is too much work for that property because there's just not that much to do. I mean, there really is, if you're dealing with more of a turnaround deal, then there's more moving components. But once you stabilize the property, your tenants are in there. I mean, you may not get calls for months sometimes. You know what I mean?
Right.
So there's just really not a lot to do except a little accounting, which we have, our bookkeeper do that. And, and we can really focus on what our acquisitions.
Got it. Yeah, I've got a few other questions, and I might be all over the board a little bit when I ask these questions. So just to bear with me here, Danny. I want to talk about credit tenants, or national credit tenants versus like the local, mom and pop, small entrepreneur guy that that doesn't have a lot of track record in whatever business they're in. So. Is it a challenge getting into this space and establishing relationships with those national credit tenants, or is it just a matter of having the right property and the right terms for that tenant?
It's definitely both. So we've got centers that have both. I have centers that are mostly national tenants, and then I've got centers that are mom and pop type of properties. So. What we look at when we're buying these assets is obviously location when it comes to commercial. What's going on in the area? Why are we going to hold this? Why is this property going to stay full? How are we going to keep it full? And so, like for instance, I just bought a Starbucks property last month, and super solid location. Starbucks has 8 years left on the lease. Verizon is also in the center, and they've got 8 years, and this property's like brand spanking new 2015 construction.
Wow.
So we have assets like that, right? And it's like kind of like, well, look, that's the best location for this area. Starbucks ain't going anywhere. I can throw a dart at a dartboard and I'm probably going to hit a bullseye with that property just because you can tell, right? If you go to the right location, you're like, look, even if they left, it's not going to be hard to find, the next national tenant that wants to be right there. Okay. So we have those kind of properties, and we like those because those are steady Eddie, long-term holds. But I also have the mom and pop centers where I'm buying them really cheap, and I'm going in and I'm creating value. I'm going in there, I'm doing the, all the cosmetic work and CapEx work and renewals of the tenants and getting them on, long-term leases. And, there maybe they only have one location, maybe they have a couple around town. And those are assets that we typically look at shorter-term holds. So we're going in there, we're fixing them up, we're filling them up, and then, we're going to go test the market on them. So, for instance, on the one I told you about earlier that we, did the new roof and parking lot and all that good stuff, and filled it up, we are taking that one to market. And, I got to just get past the 1 year hump mark here so that way I don't have to pay that short-term capital gains tax. But, we like those deals too. But the way I look at it from a protecting my downside is I bought this thing so cheap. Look, if I'm into this deal for $1.1 million, it's completely fixed up. I don't have to deal with a new roof for 20 years, parking lot for 10 to 15 years. Facades in great shape, tenants are all in there. Okay, I'm at over 200,000 in my NOI. I could lose half my tenants and still be cash flowing like crazy on the deal. You know what I mean? So I mean, it's kind of like, look, I some people say, oh, that's too risky. Well, it depends. Yeah, if you're buying it at top of the market, 100% occupied, I think there is a lot more risk involved, and so that's why I wouldn't buy one of these things stabilized. I'd buy them dirt cheap in needs of a lot of work and someone to roll up their sleeves and go in there and turn it around. Because then at that point, you're protecting your downside risk. I mean, I just bought 7 medical buildings in New Orleans that previous owner paid about $5 million for them, and we bought it from the bank for $575,000. I mean, at $20 a square foot, it's so hard to see how you could go wrong, because it's almost like it doesn't matter really where the economy goes. If you can keep a few tenants in there and even have to reduce your rents big time in a downturn, you're still going to be doing fine on a deal like that.
So in that,
as long as it's in the right area.
Yeah, I was going to say, in that particular property, why hadn't someone else snatched that up? I mean, and why did the bank let it go so darn cheap? I'm assuming they probably were trying to move it for some time, and maybe you came in and basically offered them a lower than asking offer on the property. Is that how it worked out, or?
So with CMBS, a lot of these CMBS loans are coming.
So that was
have come due.
That was a term default then. Okay, I got you.
It was. Okay. Yeah, and so the bank had it for just under 3 years, and we bought it in December. So when we went under contract, they had to get it off their books by the end of the year, and if they didn't, they were going to be penalized by the government. And this is honestly where I see some of the biggest opportunities right now in today's market, because the market's great. So you're not seeing a whole lot of value add, but these CMBS default notes are really where you're going to see the most value, because banks have to get them off their books in a certain amount of time. And so with this deal, we had a relationship with the broker previously, and they brought it to market, had just come to market, and they were asking like $1.25 million, only 20% occupied. So it needed a lot of work, right? Someone's got to get in there and clean it up. We only put about $100,000 into the exterior. But I'm already from 20% occupied. We're about 65% occupied today. We bought that last December, and we're cash flowing. And we've got two more vacancies that we need to fill, and then we'll have all 7 buildings rented up. But essentially, when we talked to the broker, he goes, "Well, look, I know you guys are closers. We have a previous relationship. What price do you guys want it at?" We put it under contract at $700,000. And that really just came with the relationship, for sure. And then once we were in due diligence, Quest Diagnostic was in there, and they were literally packing up their bags and moving out. And it was because the bank was trying to renew them at double market rent.
Oh, gosh.
And so we tried to save them, and unfortunately, they had already signed a lease elsewhere. And they would have stayed. They said, "Look, if we would have known a month ago, we'd stick around. But we already signed a lease, so we have to go." And so, unfortunately, we lost them. But I got a discount for $125,000 for them leaving, and we closed that for like I said, $575,000, which was just a crazy good price.
And what kind of debt did you end up getting on something like that was only 20% occupied? Did you actually just do that as an all cash deal?
All cash deal. Yeah, yep. We don't have debt on it. I mean, our plan on that one, because it's we were thinking of refinancing when we stabilize it, get to about 80% occupancy. We'll be cash flowing over $10,000 a month on that deal, which sounds great, but we've decided we're going to dispose of it. I'm in Colorado. This is in Louisiana. It's pretty far out there. When got to take a flight and all that. So the way we determine if we're going to sell or hold, obviously, is the tenants that where it's located, tenants that are in there, how long the leases are out for, and then looking at it from a cash flow perspective. Well, if I can cash flow $100,000 a year, but if I could sell it and get 10 years of cash flow overnight, then you really got to start thinking about hey, maybe it makes more sense to sell and then go buy another one of these, or go buy a few more of these. You know what I mean?
Yep, absolutely. Well, that actually brings me to my next question. I've got two more big questions I want to ask you, Dan, before we wrap things up. I know we're running out of time, and so I want to be respectful of your time as well. The first one being, how are you finding most of your opportunities? I mean, is it strictly broker relationships, or have you guys delved outside of the box at all and done any kind of direct mail marketing or cold calling or anything of that sort?
Look, I'm a firm believer. I mean, you can't rely on one way of marketing. I mean, I just don't think that if you want to be effective in this business, you have to crank and have tons of irons in the fire. So yeah, we do, have lots of broker relationships that we are constantly cultivating and continuing to call them on a regular basis and letting them know what we're looking for, what we're looking to acquire, when, how much, all that type of stuff. And then on the other side of it, yeah, we do direct mailing, we do cold calling, we have CoStar, we're looking up properties in our area. I mean, literally, if I'm driving around and I see a center that I like, and I'm like, hey, that looks like someone's neglecting this, and I know what I could do with it, I will write down the address, give it to my assistant, and say, hey, pull up, the owner's information on the assessor's website, and then I'll send him a mailer. And if I can get a phone number, I'd rather give him a call. Mm-hmm. So, I mean, there's all kinds of different ways to do that. But yeah, definitely you want to have lots of irons in the fire. Of
the commercial properties that you've purchased over the last couple of years, proportionally speaking, what percentage would you say came from your direct marketing efforts, whether it be a direct mail or a cold call, versus a broker bringing you a deal?
Let me think about that. I've got 3 deals that came from mailers in the past year and a half.
Okay. That's good. Yeah, that's
pretty good.
That's fantastic. Okay, good deal. Dan, anything else that we might have missed that you feel is incredibly relevant to those that are tuning in regarding commercial real estate, regarding what you're involved in today, what your core focus is today? I mean, any other relevant points? I know we could I literally have a ton more questions. We could talk for another hour about this, probably even more than that, but we're running out of time. But anything else that comes to mind that you think is could be helpful to those that are tuning in?
Look, I personally. I was really glad that I dove into other asset classes at a young age. I really felt like it opened my eyes to different opportunities, more tools in the tool belt. And I suggest that people do that as well. Now, I don't say be stupid and just go buy something because it sounds good. Surround yourself with people that have already done it, partner up with them. If it sounds interesting, you may really enjoy it. I got to tell you, there's a big difference between, office to retail to industrial to multifamily to single family. I mean, it's just each one has got its own set of unique, attributes that are pros and cons. And I personally, I'm glad that I went through and learned them all, because I know what my favorite asset classes are. I know a good deal when I see one in different asset classes as well. And so, it's been really nice to have multiple assets in the portfolio, because I'm, diversifying my portfolio and my risk and the deal structure and locations, So, I mean, I'm not all invested in one market and, betting on that market. I'm looking at all kinds of good markets and saying, hey, sure, put a little here, put a little here, put a little there. And, it's really, I feel very comfortable with, like, one of my partners had 300 homes in Houston and a couple shopping centers there. And, most of his portfolio was there. And he got really lucky, but I mean, he was one of my partners, and he was in on most of these deals I'm talking about. And he calls me up. He goes, "I can't even tell you how great it feels to know that not all my stuff like it used to be 2 years ago was all in Houston." And so it's good to get out, be in different markets, and explore different asset classes. But just make sure you're doing it smart. You're hanging around the right guys, partnering up with the right guys, and learning new tricks of the trade. No,
that's great advice. And I did have one more question I forgot to ask you, and you can just give a brief answer to this. We don't have to go too in depth, but I'm assuming that you're doing deal specific syndications for a lot of these commercial investments that you're purchasing. Is that correct?
Yeah, absolutely.
Okay.
Yeah, we're bringing in partners, and I deal with a few partners right now on a very consistent basis. We've just been consistently growing, and I've been growing our investor base, and so yeah, definitely looking for more if anyone's interested.
That's awesome. Good deal. Well, Danny, man, it's been an absolute pleasure catching up. I was looking forward to this because, again, it had been a few years since we chatted. In fact, we have to do this more often because it sounds like if I wait another 3 years to actually get you back on the show, you're going to be like off in your boat, fishing and out of contact because you've got this billion square foot portfolio. You're not going to want to talk to little old guys like me anymore.
Oh no, I will always talk to you, Kevin. I'm a very humble person. I'll talk to anybody. Honestly,
I know you are, but I
love this stuff. It's too much fun.
No, you're great at it. So that's all the more important. You're really good at what you do. You've got a proven track record of success, and so just keep doing what you're doing, buddy. And for those that have an interest in learning more about Danny and his company, you can go visit his website. It's valueinvestmentgroup.com. Again, valueinvestmentgroup.com. And Danny, that's all we have for the show, buddy. Really appreciate you coming on, and I'm serious about that. We need to make this a more regular routine. Maybe like once a year follow up with Danny. As far as we can talk more often, Danny, but I'm talking about actually having you on the show, like bringing you on the show and giving us an update on your on how things are going with your growth of your portfolio and your company and the transitions that you're making and so on and so forth. So
hey, I'd love it, man. I appreciate it. Anytime you let me know, it's an honor to be on your show. I love it. Love all the guys you have on here because I learn something new on every podcast. So thank you for doing it.
I appreciate it, Dan. You take care, but have a great week.
All right, you too, Kevin. Thanks.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.